Okay, we'll give it just a second for everyone to get logged in here and join the webinar, and then we'll get going in just a second here. Thank you all for joining. Excellent. We're slowly having people log in, so we'll get started in just a second here. Excellent. And it's a couple minutes past 9, and I'm sure some more people will be filling in the room here. So just wanted to thank you all for joining us today for this month's webinar. We call it our market update and what's to come, but really we have a great presentation planned for you today. We have Daniel Ong from Avantis Investors. They're a brand within American Century, and he has a presentation on investing through the long term and through tough times. I guess investing for the long term is what it would be, but really excited to have Daniel here. And just a couple of housekeeping items. If you have questions, please go ahead and you can send those questions to info@raccoongroup.com, and we'll all be watching the emails and hoping to answer any questions you might have related to the to the markets and where things are at right now. Also, we are recording this, so normally we open up the room so we get to see all your faces and it feels a little more interactive. But when we record, if we record all of your faces and your names, then we're not allowed to share it. And so today we won't all be in the room together, at least on camera, because then we're not allowed to share it. And so really want to thank you all for being here today. And with that, I'll go ahead and pass it to Daniel and get us started.
All right, sounds good. Thanks, Colin, and thanks for having me. Let me share my screen with you. All right, so the topic of the presentation is investing for the long term through tough times. And that's a pretty timely topic because we've been hearing from advisors that they're getting calls from their clients about a potential recession and what impact that may have on their portfolios. And especially with the first half volatility that we've seen, there's some concern about more losses to come. So we can't predict the future, unfortunately, but what we can provide is some context around how stock price changes work, what drives them, and what we've seen in these types of environments before. So over the next 15 or 20 minutes, what I'm going to do is talk about what we've seen in the marketplace, the relationship between stock prices, earnings, discount rates, what we've seen in the market, and then also provide some stock performance during periods of recession or contraction, as well as expansion, just to give you a sense. So let's get started. That's a lot to try to cover in 15, 20 minutes. Make sure I can, here we go. All right, so this is what we've seen in the marketplace. What we're showing you here is market return using the S&P 500 as a proxy for the year-to-date period. And I'll focus your attention on the right-hand side here. At the low, the S&P 500 was down about 22.5%. It did recover some towards the tail end of the first half to end down about 20%. That's still the worst first half performance for the S&P 500 since 1970. So that's the worst. That's a pretty big drawdown and the worst we've seen over the last 50 years. Let me provide a little bit of headlines here that came along the way. And you could see plenty of them on the right-hand side. High inflation, high interest rates, worry about recession, and plenty of others. We can certainly add a whole bunch of headlines here. But what we wanted to show you is that how did we get here? How did we get to this point? And you have to kind of go back to February 2020, March 2020, when the world stopped. Economic activity, financial activity, the production of things halted during that time. And that last part, the production of things stopped, that's an important one because we're consumers of goods and services. And so when you don't have the supply to go with it, then everything basically halts. Imagine a phone that has hundreds of components in it, all made in different parts of the world. You need every single one of these components to make that phone. If one of them is missing, you don't have that phone. So we had some supply side issues. Now, when you have, if you fast forward a little bit to a few months later, and the impact or the effects of the pandemics kind of subsided, then you had consumers come back. And there was a lot of pent up demand to go out again, to eat out, to travel, to consume. And we consumed a lot. The only problem is supply didn't match that demand. And what happens when you have more demand than supply? Prices go up. You have inflation. And that's not just a US thing. There's plenty of countries. Let's take the Netherlands, for example. They're very fiscally responsible, but they also have high inflation. They actually have higher inflation than the US. Excuse me. So inflation is a tough animal because it constrains growth, but it also, it's tough to control. And the Fed is trying to control this. They can't do anything on the supply side. They can't improve the supply problem. But what they can do is control the demand side, or try to control the demand side by raising interest rates. And that tries to constrain the demand, especially the demand that's related to credit. So that's what's happening. The issue with raising interest rates is that you can overshoot. And when you overshoot, you constrain the demand to the point where there's potentially a recession. And that's where you get this kind of concern from the marketplace. And how do we get to this kind of price movement? Let me provide you a little bit of perspective around what drives prices. And I'm going to use a very simple pricing model here. What do you get when you buy a security? What do you price? You price the future earnings of the company. And if $1 in the future is worth less than $1 now, you're going to have to discount those future earnings by a discount rate. And that's the R that you see here. So how do prices go up? Well, either earnings have to go up or the discount rate has to go down. Okay. The discount rate is the required rate of return for an investor to invest in a company. It's a proxy for it's what you need to entice you to invest in a particular stock or the market. Okay. That's the general simple model. Let's take that to what we're actually seeing right now. What we're seeing right now is the Fed trying to raise interest rates in order to control the demand side. So they're trying to make the economy slow down. So earnings slow down as well. In addition to that, when you increase rates, the corporate borrowing rate increases, and so earnings also decreases. On the denominator, as I mentioned before, that's discount rate. There's a lot of uncertainty in the marketplace. We don't know how many more rate hikes the Fed has, if they're going to overshoot, if we're even in a recession. And so there's a lot of anxiety and uncertainty during this time period. So you as an investor, in order to invest, has to be enticed with a higher discount rate. So you've got two things going on. You've got lower earnings, you've got a higher discount rate. That's going to impact the price. Prices will go down, and that's what we've seen. Okay, what do we do with this information? You need more information. you need more information in order to act. So what I'm showing you here are business cycles, and what we're showing here is the peak to trough. So peak business activity to the low or the trough of business activity, and then from trough to peak, what the stock market performance was. So this is the monthly market performance for the entire time period going back to 1973. You'll notice that for all of those months, the return was about 1%. Now, in periods where there's a peak to trough or a contraction in the marketplace, a contraction in business activity, the return was negative 0.2, so lower than the average for the entire month's time set. And then from trough to peak, you get higher returns. You have about a 1.2% return versus a 1% return over all of these months. Now, the question is, what do we do with this information? Now, if we think that we're in a recessionary period or a period of contraction, and you see that the returns during that time frame, peak to trough, are negative, does it make sense for us to divest? The short answer is probably not, but I want to show you a little bit more framework as to why. Like, what's the issue? Why can't we make that decision? It's because we don't know how long, we don't know when we're in a peak or trough. This is all in hindsight. We don't know what part of the business cycle we're actually in. We may be at the very early stages, we may be towards the end. So that is one of the issues. And also, the market is forward-looking. So a lot of the information, so the headlines that we saw, that's already priced in. The market has said, okay, we'll take those headlines. We thought that was coming. We're going to price that in. We're going to lower the prices of companies because we want that discount rate to be higher. So that's the issue. I'm going to show you a little bit more information that breaks up these business cycles into halves. And just for reference, when I say peak to trough, the average peak to trough time period is about 11 months. The average trough to peak time period is about 72 months, so quite a bit longer than the peak to trough period. What we're doing now is we're breaking up that peak to trough period. So in the first half of that contractionary period, what's the stock market actually done? So if the average contractionary period is about 10 months, 11 months, then we're going to say during the first 5 months of that contraction, what does the market actually do? And we've circled it here. You're getting a 2.5% monthly down period. So a dramatic underperformance. And what does that tell you? It tells you that the market is forward-looking. At any kind of sign that the market is contracting, the market's going to react very quickly to this. And so you'll see negative 2.5%. The 20% downturn that we saw year to date may already be reflected in this first half of the contraction period. The second half, so from trough to trough, was actually positive. So you could be in a contraction period, but you're at the latter half of the contraction period, and the return is actually positive. Now I'll show you the trough to peak also. When you go from the bottom towards the peak, and you go for the first half that time period, the average return was about 1.34%, and the second half was about 1.05%. We think the more interesting information is in the peak to trough, especially during the first half, because this is where there's the most market anxiety, and this is where advisors do start getting the calls. Hey, should I move out?
Okay, can I ask a quick question here, Daniel?
Sure.
I was just curious, do you think it moves faster now with the way information flows? Are people trying to price the market even more quickly because we have access to thousands of data sources at kind of every minute?
It's true. We have more access to information. We look at social media. People tweet things, and sometimes the tweets are good, sometimes the tweets are bad or not true. But the markets will react very quickly, even quicker than what we've seen before as a result. Whether that market movement is correct or not, that's to be said. But it does react very quickly. All right. So I've showed you the time periods. Let me give you a little bit more information in terms of a case study. So we use 2020 as a case study, and you recall 2020 was a period of high anxiety. This time it's different, and yes, the pandemic it is different, and many of these types of case studies are going to have different circumstances. What doesn't change is the market is forward-looking, and it still continues to react very quickly to things. But going back to 2020, investors had a lot of anxiety to the point where they actually moved money from the stock market into money market funds backed by the government. So what you're looking at here are the flows, are the weekly flows in February, March of 2020. And so you had investors that are moving money from the stock market into these government money market funds. It's a flight to safety. It's probably the ultimate flight to safety. And this red bar right in the middle represents the outflows that happened during the week ending March 25th. There's a lot of money that's flowing out, $345 billion that flowed out during that 1 week. So what we wanted to show you, this is more a highlight on investor reaction. What we wanted to show you is, how did those investors fare? Was it the right decision to move out from the stock market into a money market fund? And we're using here as a base case, let's forward to the end of April and compare that return that the investors got moving to a money market or staying invested in the S&P 500. And at the bottom, you'll notice that the vast majority of investors that moved money into money markets would have underperformed the S&P 500, and that's your opportunity cost. There are a few of these investors that divested from the stock market early, the first 2 weeks, that actually were better off doing so. So they timed it right. The issue is they need to time it right getting back into the market. So yes, if you fast forward to April 30th and they got back in on April 30th, they would have made money. They would have been better off. But if you take that time frame a little bit further to May 30th or June 30th, all of the investors would have been worse off divesting from the stock market and moving into the money market funds. That's the issue with timing. It's great. You have to be right twice. You have to be right in terms of the timing getting out, but you also have to be right in terms of the timing getting back in. And so a lot of investors during this time frame were making decisions based on information that they didn't really have. It was more on sentiment. I'm worried. I have anxiety about being invested in the stock market. I don't like the type of volatility that I'm seeing in the market. I'm going to move out and move into money market funds. And what we've seen historically is it typically doesn't benefit clients to make decisions based on sentiment. If you're making it based on risk tolerances, that's fine. That's where advisors can help you out. But if you're making it more based on sentiment, they're usually not better off. Now, a different way of looking at 2020 is this timeline. And what we're showing you here is the S&P 500 return starting in 2020, going all the way to the end of 2020. And we knew, and we know in hindsight, that 2020 actually ended up being a pretty good year in terms of overall stock performance. But what we're showing you here are headlines that went along the way, as much as we could fit on one page. And all of these headlines, at one point or another, could have swayed your discipline staying invested in the market. And what we're showing you at the bottom are those government money market outflows. And you can see here, February to April, there was plenty of investors that moved out, had net flows go to money market funds. Would they have been better off staying in the market? Yes. Does discipline tend to pay off when being invested in the market? The answer is yes. Okay, so I've got my last slide because I wanted to provide some additional perspective here. What you're looking at here are past market downturns, big market downturns. So in green, we've got 20% downturns. In gray, you've got 10% drawdowns. If we showed you 5% drawdowns, this entire graphic would be filled with lines. You couldn't even distinguish. The point of all this is to show you that being invested in the stock market comes with these types of drawdowns. They're somewhat common, and it's like if you're driving around town in your car and you don't like red lights, you're not going to stop driving around town in your car just because you don't like red lights. You've already accepted that red lights are a part of driving, and that's what the stock market is also. You may not like the drawdowns, but it is part of the animal of being invested in the stock market. And so that's hopefully what this graphic provides some perspective on. So just to sum it up here, volatility and anxiety are natural. They are a part of being invested in the stock market. Does it make sense to act on this information? It usually doesn't. The market is forward-looking. It prices things very quickly. So if you're making information based on headlines that you saw or news, pundits commentary that you've heard, it's usually already priced in the marketplace. So if you're making a decision, you should have information that's beyond what the collective market has already priced in. And so having discipline is critical during this time frame where there is that volatility and anxiety, and that's where your advisor can also help. If your risk tolerance has changed, if your goals have changed, that's where your advisor can help with that. All right, I'll pause here. I'll open it up to any questions that you may have.
Great, thank you, Daniel. Maybe we can turn the screen share off and we'll
Sure.
dive into some questions here. Maybe a good place to start. I'm a big data person, and I really like to geek out on data and look at the past and what's happened. And
Yeah.
The past always sort of says like, oh, things generally correct and move forward and go upward. But if we're looking at the market, how would we know like that this time isn't different, or what could actually make this time different?
Yeah, the short answer to that is we don't know. We don't know if this is truly a different time period, right? But what we do know is that the market is more forward-looking. That doesn't change. The market will always be forward-looking. At some point, fundamentals come into play. Sometimes there's a disconnect and fundamentals are removed. So you have periods where there's meme stocks, and maybe it's different this time. But at some point, fundamentals come back, and these things tend to change very quickly on a going forward basis. Trying to time the market is usually not the best answer. But the short answer is we don't know. We've seen many different environments. Sometimes the movie looks familiar. It's not the same movie, but the movie looks familiar. We've seen this kind of version before, and usually it makes sense to stay invested, to be invested and stay invested.
Great, thank you. We'll open it up to more questions. So again, if you have any questions, please feel free to send those along to anyone on the team here. Maybe we'll have Contessa jump in for a second And I believe she has a question from the crowd here.
I
Contessa?
do, and it kind of it relates a little to Kyle's question.
Okay.
We know that we don't want to just jump out of the markets and go to cash,
Hmm.
that you're better off staying invested for the most part.
Hmm.
But being that this environment is different than what we've ever seen before,
Hmm.
would you suggest positioning people's portfolios different or sticking with that strategy that they've always had or reassessing their risk, or what do
Yeah.
you see
Yeah.
with that?
That is a personal question because it really depends on your own personal risk and goals. But from our perspective, at least, we're a systematic manager. We want to make sure that we're invested at all times, and have exposure to higher expected return companies at all times. So companies with high profits and low prices at the same time. Uh, what we've seen, and hopefully what this data has shown, is if you have a certain goal and a certain tolerance in mind, that part, if that doesn't change, then it makes more sense to remain invested, because timing, moving from, you know, emerging markets to US during this time frame, especially in this time of volatility, is very, very difficult to do. So in many cases, it makes sense to stay put, um, unless, of course, your tolerances have changed. And then in that case, that's a conversation that you should have with your advisor.
Great. Thank you, Contessa. Do we have any other questions that have come in? Let's see. Okay, yeah, I mean, I guess we see sort of the same questions. We talked about this a little bit during the presentation. Is
Mhm.
there's a lot of kind of that desire for timing the market that goes on, right? Is that
Yeah.
kind of cash on the sidelines conversation? And are there scenarios where you see that it makes sense to have cash on the sideline aside from your personal things, right? Like you're purchasing a house or you have to pay for a child's education, but are there scenarios where you guys look out and you say, here's a place where we're going to up cash in our portfolio?
Uh, the answer is no. The answer is no, because cash, the long-term expectations of the stock market are that much greater than being in cash. So, and usually when there's an uptick in the stock market from what we've seen, it tends to come in bunches and it comes very quickly and very dramatically. So if you miss the first part, and I showed parts of this, if you miss that first part of the recovery, being in cash can be very detrimental to the overall returns of your portfolio. And so we don't make that call. We don't want to have a tactical allocation to cash because we think we have more information than the marketplace. We're going to be invested at all times. And what the data shows is being invested at all times tends to actually do better than trying to time. And that's because, again, if you miss that first part of the recovery, that's very detrimental.
Yeah, if we recall March of 2020, the money market funds that people were moving their money into were paying essentially 0% already,
Right?
and they were moving their dollars there and
Right.
just to earn zero and basically try to
Yeah.
protect or preserve their capital.
Yeah. And in hindsight, they've already experienced the pain of being invested in the market. Had they stuck around for the gain, they would have been better off in the end. You fast forward to the end of 2020, they all would have been better off remaining invested. So kind of confirms the point that being disciplined tends to pay off. And that's not just in 2020. We can go back to 2008. We can go back to many, many different time periods. They're all different versions of the same movie.
Great. So we have a slightly more technical question that came in, and we'll give you discretion if you want to get into it, and if not, we'll bounce back a response to the client. But
Okay.
Just if you could talk just for a minute about the relationship between the money supply and inflation and deflation that we're seeing right now.
That one, we should probably get back because it tends to be pretty, it's going to get involved. So why don't we table that one, and we'll send a written response.
Great, thank you.
Okay.
And I think in general, what we see, right, is that there's more money in circulation, and when there's
Yeah.
more money in circulation, it creates inflationary pressures on the markets,
Yeah.
and then
That's
the
what we've
difficult,
seen.
yeah, and
That
then the difficult piece is how do you actually pull that back and decrease the money supply? And I think that's something the Fed's trying to deal with now, but it's a very difficult thing to pull it back, especially when the Fed is, you know, acting in contrast to sort of what Congress or the executive may be doing with, you know,
Yeah. Yeah, and that's what we've seen with quantitative easing. That's really a boost of money market supply. And now with the removal of quantitative easing and the potential for inflation, it's quite the opposite because the Fed is now trying to control the demand side, and so you're kind of having the opposite effect. But we can talk a little
yeah,
bit more
yeah.
details on that.
We'll give a more formal response.
Yeah.
So, uh, you know, how, you know, as we look at sort of the shifting in the market, we're seeing sort of like a change from where, you know, it almost felt like growth was easy. You know, you could go out there and you could grow your portfolio with stocks.
Yeah.
You know, as people are kind of really reevaluating their goals, they're realizing the importance of income
Mm-hmm.
to their portfolio. And so,
Mm.
is there a point where you really see like that need to, I guess, shift towards more income producing assets, or, you know, I guess, right, like a dividend payer versus a real, you know, a growing company? Does it make more sense now?
Yeah. So the goals of our portfolios are just to provide the overall total return, the highest expected return, and that is total return to our investors when they're invested in equities. So if income is an issue, if that's the goal of the client, typically, you know, that's why we have fixed income strategies and different versions of fixed income that may provide higher yield for clients. But from our standpoint, when you're focusing on higher yielding companies, it changes the characteristics of the overall company. So you it's kind of a version of value, right? You have higher yielding companies, they tend to gravitate towards value. The only issue is it's not a good proxy for value, and because some companies pay and some companies don't, so it's not really a good version of value. What we're doing instead are focusing on value companies, so low price companies that have good fundamentals, that have good cash flows. They may not distribute them, you may not get a yield from them, it's going to be accruing to the shareholder in some form or fashion. It could be via the capital appreciation portion. So
Maybe just quickly, if you want to just give a snapshot about around how Avantis looks at value, like what
yeah,
really do you consider value when you're evaluating a position?
that is a very good question, and maybe the best way to put it is, you know, in a normal person-to-person example, what do you consider value when you think about a restaurant experience? Well, value is going to a restaurant, getting a good ambiance, getting good food at a good price, right? That's value. It's not necessarily just buying the cheapest or finding the cheapest restaurant. That's not value. It's basically what you get for the money, the experience that you get for the money, right? The bang for the buck is also important. And so that's the same way that we look at stocks. We don't necessarily want to buy just the cheapest companies out there because there's cheap companies that are cheap for a reason. They've got very poor fundamentals. What we're looking for in terms of value are low priced companies that have good fundamentals, that have high profits, that have high cash based operating profits. And so that's the combination that we look for. When in our value strategies, we'll be buying the stocks with the highest combination of low prices and high profits at the same time. And that's very different from your indices out there that are just buying the cheapest stocks. That's a good first step, but some of those stocks are going to be cheap for a reason. We don't want those.
Mhm. Yeah, we have a couple of questions that came in, but maybe if I could just follow up on this topic just for 1 second. So we've seen
Yeah.
a lot of these. I mean, I won't, for sake of compliance, I won't name any specific companies, but we've seen some very, you know, large cap technology companies or technology adjacent companies that have basically moved from being high growth companies to metrics that people now consider value. how do we sort of manage that, right? Because they're falling in price,
Yeah.
which is what moves the metrics that make them appear to be a value. But is there a way we should be looking at them different because they were high flyers and now all of a sudden they're considered value?
Yeah, and that goes back to the pricing model that I showed before, right? You have a price. What are you paying for the price? You're getting earnings divided by a discount rate. Now, maybe some of these growth companies, the earnings are decreasing, actually decreasing. And there's some market anxiety, and so the discount rate increases, so the price drops. But at some point, the market is going to price it that the expected return on this company is positive. So the price goes down low enough so that the expected returns on these companies are positive. And you can, am I allowed to use company names at all,
We'll
or
try
should
to
I not?
avoid them
Okay,
if
well,
possible.
we're gonna avoid that. But let's say you have a big technology company using personal products that almost everybody in the world uses. Well, they are very highly profitable. They tend to be very highly profitable, but when you look at the price, maybe it's not a value company. It's not the cheapest company out there. But let's say it's an average price. You're getting very high profits at an average price now. That's also value. You're getting pretty good bang for the buck. Value is two sides of a coin. You could buy something for very cheap, or you can buy something or you can buy something that gives you the biggest bang for your buck. And some of these technology companies out there are giving good bang for the buck. And so
Great.
it's important to look at both aspects, bang for the buck and how cheap these companies are.
Thank you. So a question that came in is one I find really interesting as well is if you could just talk about the disconnect between a market downturn and an economic downturn, because I think what we're experiencing now is what we talked about at the beginning, is we're seeing the market react immediately. And so we have that market downturn, but we're not necessarily sure if it's a real economic downturn or not. But maybe if you could comment on it.
That's a good point, because the market, as I mentioned before, is forward looking. And so it's already pricing in some kind of chance of a recession. We may not actually be in a recession. If you look at different metrics, we're not in a recession yet. We may be in a recession next month, or officially in a recession next month or 2 months from now, but the market is already pricing it in. And so it usually ends up being a more of a leading indicator of where we're going to be versus a lagging. It doesn't happen at the same time usually. And so that is the difference, is the market, you saw a 20% downturn. Well, you may see a recession now. We may be in a recession now, or we may be in a recession in the near future, but the market has already priced it in, or at least some portion of that.
And if there's not a recession, then we would expect a faster recovery of the
quick
market.
upturn, because the market there's a layer of in terms of discount rate that's saying, oh, there's a lot of anxiety. I think there may be a recession. Well, that discount rate has to go up, right? But as soon as the market realizes, oh, it's not going to actually be a recession, or it won't be as bad as we think, that discount rate drops. And when that discount rate drops, prices move up very quickly. Nothing has to happen on the earnings side. It's that market sentiment, that discount rate, that moves very, very quickly.
So say if we remained invested, so we didn't go to cash, but we waited too long to adjust sort of our allocation toward aggressive positioning, right? Where aggressive positioning was the winner throughout 2020 and a portion of 21, depending on how you look at it, right? And we held that portfolio, and people are saying, is it too late to change how I'm positioned now while staying invested? But is it just too late, or should I be moving into another asset class, kind of looking forward?
Yeah, that's the so now we're moving away from, oh, should I remain invested in stocks versus fixed income, for example. But now let's say within stocks, there's different market segments. You have US large cap growth, you have US small value. What we're actually seeing in terms of those valuations is that US large growth has run up dramatically over time. US small value has kind of remained steady over time, but it's US large value that's moved dramatically. to the point where we're seeing levels. We saw levels that are beyond what we saw in 2000. The tech boom. What we're seeing in the data is that when there's kind of a divergence of US large growth versus small value, when it gets large enough, the subsequent premium or the subsequent extra return you get for being invested in small value ends up being larger than normal, larger than history, larger than the historical numbers. That's not a timing comment. I can't tell you when that premium is going to happen, but what the data shows is that the premium tends to be larger. So if you can't really time it, it just makes sense to be invested in those in the small cap value area at all times. Not 100%. If you're
Of course,
if you're looking
no,
for higher
no,
expected returns,
we're
that
not
is the
going with
area.
we're not going with the hot stock tips today.
Right,
We'll
right.
save that for another call. But
Right.
no, I think that makes sense, right? It's another plug, sort of to what we're always trying to look at is saying like, what is the right diversification strategy? We're saying if we were extremely aggressive with a portion of the portfolio, you need it to match sort of a long-term risk tolerance for that client or for that specific situation, while also having assets that balance it out in a proper way.
That's right. That's right. And look, small value has underperformed. Let's say the last 10 years, and clients may be hesitant to invest in small value because of that, because there's a recency bias. Well, again, that's probably the better time to invest in hindsight, to invest in small value on a going forward basis, because the premiums tend to be larger when you have this type of underperformance.
So I go into my insurance guy's office and he's got the chart on the wall with like the growth of $1 if you invested $1 in small company stocks and large company stocks, and what it would look like from 1920 until basically 2000 or 2020. And we see small caps are, sort of the winner there in some ways, but there's sort of a perspective from the general population that smaller companies are riskier. Is it a matter of risk, or is it they just experience increased volatility, which might be a measure of risk, I guess? But is that what we would expect? Is they have more volatility? But if we're looking at a long-term growth, is it really more risk if you're kind of have that reward on the back end and this is the very long term. We're looking at a 100-year chart, of course, right? But just curious, like how do we look at risk of small companies versus large companies?
Yeah. So if you look at the historical numbers, the difference between large caps and small cap stocks, it ends up being about 2.5% more for small cap stocks than large cap stocks. But when you if you decompose the small cap universe into companies that have low prices and high profits, and the ones that have high prices and low profits, there's a really big difference between the two. So there's about a 10% difference between those sets of companies. So it's really tough to say all small cap companies should have outperformance, because what's really driving the outperformance are the small cap companies that have low prices and high book to market. The ones that have high prices and low profits actually underperform large cap stocks. So it's a really important distinction. We don't say all small cap stocks should outperform large. It's the ones that have high profits and low prices at the same time. And why would they have high returns? Well, that goes back to the pricing model. You've got high profits and you've got low prices. Well, then that last component, the discount rate, must be high. It must be high. And so that is the proxy for an investor's expected return being invested in that type of company. And that's why they should have higher expected returns. Why does the market assign a higher discount rate? And that gets to your question. Well, there may be more risk involved. There's maybe a clientele effect where certain investors don't want to invest in that market, and so prices are depressed. So there could be many different reasons why the market is discounting those companies more, but that is really what's driving the small cap effect. I'm sorry that's really long-winded, but
That's okay. That's great.
that's kind of our jam is talking about small caps. So
Ah, how should, so we'll shift a tiny bit, but how do we look at Europe right now or international markets
Yeah.
when, you know, we're seeing sort of, I mean, we feel a lot of turmoil in the US and what's going on in the world, but Europe being is adjacent and really right in the middle of everything. Like, should, you know, I don't know if should we be looking at Europe through a really different lens?
Yeah, I mean the uncertainty in Europe is quite a bit more, and so you could see that in the discount rate and the prices that you've seen in developed markets. It all kind of boils down to going back to that pricing model where there's more uncertainty, and as a result, you're seeing an underperformance in the developed markets in Europe relative to the US, where there's, let's say, less uncertainty. We have plenty of uncertainty, but just less. And so, yes, you could look at it from a different viewpoint, but would you act on it any differently? Probably not, because it's already reflected in the price. So unless you have information that goes beyond what the collective market has already priced in, you know, it usually makes sense to be invested and stay invested.
Great.
I know I'm repeating myself a lot.
No. I mean, we often do these talks a lot, and sometimes, or we do our quarterly updates, and there are pieces of it which are sort of the broken record, because what it is that there's parts of investing that are just fundamental that will remain true sort of always.
Yeah.
They're just they're there until there's something that really breaks the pattern from what we've seen over, I mean, obviously I'm not 100 years old, but over the last 100 years that this pattern has repeated itself over and over again. And that's why the talking points often sort of feel constant.
Mm-hmm. Mm-hmm.
So something that maybe it's 100 years old, but probably more in the news now, and something that we talk about investing quite a bit is ESG, or investing sort of using certain metrics which follow environmental, social, or governance for the group. That's what ESG stands for. But just curious, I mean, what does that really mean for the market right now? Is it something that really impacts returns or performance, or is it just a way for investors to really feel better about their investments? How are we looking at ESG?
Yeah, so in many cases, some of the ESG strategies out there are so that their investments, so their client investments are aligned with their beliefs, right? So some of these ESG strategies will not invest in companies that have that will not invest in companies where there's ESG concerns. Does that impact the company when someone does not invest? No, they've already raised their capital, right? And you as an investor can't call up the company saying, I'm not a shareholder of your firm, but I would like for you to change. I would like for you to change these aspects of your firm, like your emissions. They're not going to pick up the phone if you're not a shareholder, right? So a lot of the ESG strategies are more to align investor values. There are some ESG strategies out there that actually are trying to have an impact. So they're shareholders of the firm, and they're actually calling those firms and saying, I'm a big shareholder, and here's what I would like. That can have an impact. Now, if there's a I'll move it back to discount rates here. If there's a discount rate for a company that has bad ESG standards, and the company actually improves it, that discount rate lowers and the price improves. So you can have an impact if you're able to lower the discount rate of the company. Is that
are we getting to a sophistication point with ESG investing where you can actually say okay, this company doesn't strive for these standards. Is it a real risk into the future?
Yeah, so a lot of that should already be priced in, right? If there are ratings out there, if there's investors out there that are looking very closely at the risk aspect of investing in these types of companies, uh, then that should be priced in. The higher the risk, the higher the discount rate, the lower the price. So it's more around, well, what's going to happen going forward? How can you impact it going forward? That's how you impact the price of securities on a going forward basis.
Do you think, I mean, can we really look, do you think we really can look at that? I mean, I don't know. I sometimes wonder, like, if, like, when we're looking and saying, like, oh, are we properly evaluating the risk? And you don't have to answer that. There's not really a question there, but that's something I'm curious about constantly, is saying, like, oh, we vote with our dollars a little bit and we move to other positions, or because we worry about the risk of this company long term.
Yeah.
But also, I just don't know how well we're really aware of what it looks like into the future.
It's tough, right? I don't have a Bloomberg screen that says, well, this is how much is already priced in. We know that there's ESG investors out there. We are one of them, that are, we offer ESG products. So we know that there is a marketplace that actually reacts and invests based on those values and beliefs. So some of that should be priced in. In terms of the, does investing in ESG actually give you higher expected returns? The word is still out on that. It's a relatively new field. The data is relatively short, and so the word is still out. The chapter is not closed yet. What we do say, or what we do in our ESG strategies, is focus on the things that we know has shown higher expected returns. So companies with low prices and high profits, we're going to do that in the ESG strategies as well, but exclude the companies that ESG investors are concerned about. So in the end, you have a portfolio that still has higher expected returns. It's not driven by the exclusions of ESG. It's driven by the engine that runs our normal traditional strategies. But you're getting an investment that aligns with ESG investors with higher expected returns. It's a different approach.
Mm-hmm. Great. So, as we're kind of approaching our wrap up here, maybe just dive into something kind of fun, is just thinking, like, at Avantis, or you personally as an investor, what is the thing, like, when we're at this point in time that feels pretty terrible as we kind of go through the year, but what is something that, like, makes you excited going forward, or kind of brings you joy about where we're at in the market right now? Maybe joy is the wrong word, but what would be something you're excited about moving forward?
I'll give you a personal story, because my dad is an investor, and he does invest in Avantis investors, but he also has very personal feelings about the market, and usually when he's very pessimistic on the market and has a lot of anxiety, that's the bottom. And he's been very worried about the market. He's been very pessimistic on it, and so I think that's a good contrary indicator for me. So I get some joy out of that. I mean, there's a lot of negative headlines out there. We're all looking for some kind of light at the end of the tunnel, and that is my light at the end of the tunnel. Is that if he's worried about the market, then maybe we're reaching that point, or we're getting close to that point.
Well, I'm glad your father's pessimism can leave us with a little optimism for the group. That's pretty great.
Yeah.
So, well, and hopefully that's true. I mean, it's been pretty extended as we go through the year, the market downturn, as we continue to feel it, especially after going through 2020, where we had such a rapid recovery from the downturn, where we had February into March, and then the market changed its mind very quickly, and we're experiencing something really different now. And so as we experience it, the duration which we're dealing with right now, it makes it harder and harder to kind of to stick it out, but really knowing that there should be optimism in the long run and into the future.
Yeah, and as I mentioned before, the periods of contraction tend to be shorter than the periods of expansion. contraction on average is about 11 months. We don't know how long this one will be, but on average, it's about 11 months. The expansion is 72 months. So that's what gives me some optimism. We've experienced a pretty bad 6 months in terms of stock performance or market performance, but hopefully that's part of the pricing in of what we saw the first half of the contraction period.
Great. Well, it's really great. Thank you, Daniel, so much. Just for the clients out there, if you have additional questions, either for the team here at Raccoon Group or for Daniel and the team at Avantis, please feel free just to send them along to anyone on our team. We really, enjoy interacting and answering questions, as does Avantis, and they're a really great partner to us. And so, Daniel, I really thank you for your time today, and it's appreciated.
It's my pleasure. Thank you for having me.
A last housekeeping note is just beyond the questions, we'll also be hosting another event, I believe in September. So keep an eye on your emails. We're going to be doing a political update ahead of the midterm. So that should be an exciting event. So keep an eye on your emails for that. It'll be coming up. And thank you again for joining us today. And we look forward to interacting with you all soon. Thanks again.
Thank you.